Welcome back to macroeconomics class, and today we'll be discussing on international trade and finance, international trade and finance, and in doing that, the module delves into the dynamics of international trade and finance, crucial for understanding global economic independence. And we will cover foundational theories, the balance of payments, the exchange rate system, and then the trade policy. As per the trade theories, we examine absolute and comparative advantage as basis for specialization and mutual benefits. Also, we will look into the balance of payments where we'll be able to interpret a country economic transaction with the rest of the world, and also the exchange rates where we understand fixed versus floating system and their implication for stability and um, policies. And we will look into the trade policies where we will be able to analyze tools like tariff and quotas and their impact on industry and international relation. Looking at an overview of international trade and finance, we see that international trade and finance represent a central component of macroeconomics analysis, dealing with the economic interaction between nations and the flow of goods, services, and capital across borders. And in an era characterized by global economic independence, no country can afford to ignore the dynamics of international trade. And also, nations engage in trade not only to access goods they cannot efficiently produce domestically, but also to expand their markets and improve productivity through specialization, and also foster economic growth. And at the same time, the global financial system influences how countries um, manage their currencies, attract investments, and maintain external balances. Now we move into looking at the trade theory as said in the introduction of the module. And we said we have the absolute and the comparative advantage. And for this concept, explain why countries specialize and trade even when one country is more efficient in producing all goods. And we look it first from the absolute advantage. And this is introduced by Adam Smith, and it shows that a country has an absolute advantage if it can produce a good using fewer resources or at a lower cost than another country. An example of this is if Nigeria produces crude oil with fewer labor hour than Ghana, Nigeria has an absolute advantage in crude oil. And for comparative advantage, it is developed by David Ricardo, and it stipulates or shows that a country has a comparative advantage if it can produce a good at a lower opportunity cost. And just like we said, opportunity cost is the alternative cost that was forgone. And if they produce a good at a lower opportunity cost compared to another country. And for example, if country A sacrifices less clothes to produce rice than country B, then country A has a comparative advantage in rice. Another concept is the balance of payments that as we said in the introduction to the module. And when we talk about the balance of payments, it is a comprehensive record of a country's economic transaction with the rest of the world, and it is crucial for assessing external economic health of the country. And as such, we have the current accounts under the balance of payments. You have the capital account and you have the financial account. When we talk about the current account, it is used to record flows of goods, services, income, and current transfers. Example include exports, imports, and remittances. As per the capital account, it is used to record capital transfers and non-produced, non-financial assets in terms of debt forgiveness, patents, and the likes. And for financial accounts, it is used to track investment flow, including direct investment, portfolio investment, and reserve assets. Um, how then do we balance global transaction? In theory, the balance of payments must balance. In theory, the balance of payment must be balanced, and persistent imbalances signifies um, economic strengths or weaknesses, and it influences policy decision. And as such, if we will talk about a uh, balance of payment, we see that the current account plus the capital account plus financial account plus error and commission is equal to 0. And what are the importance of the balance of payments? The first is, as per the economic indicator, as it serves as a vital sign of a country's external economic stability and performance. Also, as per the policy formulation, its persistent deficits prompt adjustment in macroeconomic strategies such as exchange rate policy. And as per investors' confidence, a stable balance of payment enhances investors' confidence, while imbalances can deter foreign investment. And lastly, as per the exchange rate, the movement in the balance of the payment components influences currency supply and demand, affecting the exchange rate. Now, what are the two components we need to look into as it pertains to exchange rate? And the exchange rate is the price of one currency in terms of another, impacting trade, competitiveness, and economic stability. And for fixed exchange rate, under this, currency value is pegged to another currency or asset. That is, the central bank intervenes to maintain parity. And what are the advantages of the fixed exchange rate? The first is stability, also predictability. Also, it aids inflation control, and it boosts the investors' confidence. And what are the disadvantages? It leads to loss of monetary policy independence, vulnerability to speculative attack, and high reserve requirements. And it involves high reserve requirements. And as per the floating exchange rate, under this, the currency value determined by its currency value determined by market force of supply and demand without direct central bank intervention. And the advantage of floating exchange rate is it enjoys the monetary policy autonomy. Um, Also, the automatic adjustment to trade imbalance, and also the lower reserve requirements. It enjoys the lower reserve requirements. And as per the disadvantages, the first is volatility. It also experiences its uncertainty is another challenge. Also, it's the imported inflation and speculative pressure. These are disadvantage of the floating exchange rate. The tariff, as per the tariff, we look into it as taxes imposed on imported goods, making them more expensive and protecting domestic industry. And what are the types of tariff that we have? We have the protective tariff, which is designed to shield domestic industries by raising the cost of imported goods. Also, we have the revenue tariff, which is intended to primarily raise government revenue without necessarily limiting imports. Also, we have the retaliatory tariff, which is imposed in response to unfair trade practices by other countries. And we have anti-dumping tariff, which is levied when foreign producers are believed to sell below cost to undercut domestic competition. And the economic benefit of tariff include high consumer price, benefit for domestic producers, and also government revenue, and lastly, potential trade disputes. The second is the quotas, and when we talk about the quotas, they are quantitative limits on the amount of a specific goods that can be imported, directly restricting supply. And we have the types of quotas to be the import quota, export quota, and the tariff rate quotas. And for import quotas, it deals with the maximum quantity of a goods imported, and the export quotas, um, it's this its limit amount of a goods exported, and tariff rate quotas lower tariff for a certain quantity, higher for import above that. And what are the economic effects of quotas? As per consumer, leads to higher prices and reduced welfare. Also for domestic producers, they are shielded from competition, and also lead to potential expansion. As per government revenue, generally no revenue unless license are auctioned. And lastly, as per the foreign exporters, it leads to higher profit due to limited competition. In summary, international trade and finance are crucial for global economic growth, and driven by comparative advantage and managed by various policies. So we've been able to look into the specializations, where we talk about the comparative advantage and absolute. Also, we've been able to look into the balance of payment insight, where we say balance of payment track economic transaction, revealing a nation's external health. Also, as per the impact of exchange rates, we've seen the fixed or floating rates being a tool in influencing trade competitiveness and monetary policy. And finally, we've looked into the policy trade-off, where we see tariff and quota as one which protects individual industries but can raise prices and spark disputes. Thank you.